Look out below. The market's falling, volatility spiking, and everyone's screaming crash. But let me ask you, is this the start of the next market meltdown, or is it exactly what strong markets need before the next leg up? Because if you zoom out and look at what's really happening, the story isn't panic, it's opportunity. Let's break it down. The SPY dropped again, closing around 670 after back-to-back inverted hammer candles, something I warned about earlier this week. That pattern often signals exhaustion at the top, and when we broke 674s, the door opened right to 669, which we hit perfectly. Now, before we start calling it a crash, zoom out. We're still up more than 20% on the year and only about 3% off all-time highs. That's not a crash, that's a textbook pullback. The 50% retracement from this last leg higher sits right around $660, and the 61.8% level, the golden pocket, is 667. Historically, that's been a sweet spot for buyers to step in and reestablish trend strength. I'm watching 667 to 665 as the key zone. If we hold above 660, supported by the 50-day moving average, this is still a healthy higher low in an ongoing bull trend. But if 660s breaks and volume spikes, then we can start talking about deeper correction territory. Tech led yesterday's slide, pulling QQQ down nearly 2%. We're only about 4% off highs, so again, perspective matters. Support at $612 held briefly, and that's still the battleground for today. Below 612s, I'm eyeing $606 and $602 as next major levels, both aligning with moving average confluence zones. Here's what's interesting. Semiconductors and big cap tech led the downside, but volume hasn't exploded yet. That tells me this is more of a cooling phase than a panic sell. For longer-term investors, this kind of controlled retracement is where future breakouts begin forming. Patience is key. NVDA lost nearly 4% yesterday, and it's sitting right on $188 support. The entire semiconductor sector is under pressure, but NVDA's trend structure still looks constructive above $184. If $187 breaks, watch $184 and $180. Those are natural next supports, and the 50-day moving average aligns right there. The bigger story here is sentiment. After months of AI-driven hype, traders are rotating out temporarily, but each of these pullbacks has historically given long-term investors a better cost basis before the next move higher. AMD is showing the same pattern. We broke 240 and now sit near 237. A key pivot. The Fibonacci 61.8% retracement from the last big move sits around $226. If we continue lower, that's a logical magnet. Above $240, bulls could regain momentum. But until that level is reclaimed, this chart favors patience over aggression. Semiconductors are leading tech weakness right now, and AMD's volume confirms that rotation out of risk. PLTR had a sharp 7% drop, breaking down to $175 support. That's the lower edge of its recent consolidation range. And if you look left on the chart, you'll see multiple wicks bouncing from this same area. That tells us buyers defend this level, but we still need structure to form before confidence returns. The 50-day moving average sits just above $175 and could act as resistance if we push back up. Speculation around an AI bubble isn't helping sentiment here. So if $174 fails, the next key zone is $171 where prior buyers stepped in strongly. This one is fascinating. Hood has printed a clear double top pattern around $153 and is now flushed to $127. A textbook technical breakdown. If you're a chart purist, you know the measured move from that pattern could reach $100, which also happens to be a significant support area from August. Whether we get there depends on the broader market's tone, but it's one of the cleaner technical setups in play. A retest and rejection of $131 or an hourly lower high would likely keep sellers in control. AMZN slipped into its post-earnings gap and closed near $243. That's an important signal, because inside that gap there's very little recent price memory. Once gaps start to fill, they often fill completely. The bottom of this gap sits around $227. That's my target area. We're not talking fundamentals here. Amazon's business remains strong, but technically the path of least resistance short term is down until that gap is filled. After that, the chart resets and strength can rebuild. OKLO's chart screams caution. We've got a clear head and shoulders pattern, neckline broken at $109 and now trading near $105. This is a newer high volatility name, the kind where patterns tend to play out fast. Below 103s, it opens the door to $96 and potentially $91. On any bounce, the $109 level is your critical line in the sand. Unless it can reclaim that as support, momentum remains firmly bearish. Here's the broader view. Volatility has jumped, risk-on sectors are cooling, and headlines about the record-long government shutdown have created that perfect cocktail of fear and uncertainty. But here's the truth. Markets need fear to fuel the next rally. Every correction shakes out the weak hands and resets sentiment. Zoom out and the structure still says strength. Long-term trend lines remain intact. The 50 and 200-day moving averages are sloping upward, and institutional flow hasn't reversed direction yet. This isn't a crash. It's the system taking a breath. So instead of panicking over red candles, study the levels, understand the structure. Smart money isn't scared, it's patient. This is when discipline, not emotion, creates opportunity. And remember, the goal isn't to catch every move, it's to master your reactions when the market moves against you. Stay disciplined, stay patient, and keep building generational wealth.